Forward Guidance is brought to you by VanEck, a global leader in asset management since 1955. You'll be hearing more about a VanEck ETF later on, but for now, let's get into today's interview. I am very pleased to be welcomed to Forward Guidance Wayne Dahl, Managing Director and Co-Portfolio Manager at Oaktree Capital Management. Wayne, great to see you. Welcome to Forward Guidance.
Thank you, Jack. It's a pleasure to be here.
It's a pleasure for me to interview you, Wayne, and I'll tell you why. On this program, Forward Guidance, we've done a lot of work, a lot of interviews on the banking system, and the banking system is important. They create a lot of credit, but increasingly, a lot of credit around the world, but particularly in the United States, is being underwritten and created outside of the banking world. And Oaktree Capital Management, where you work, is a leading place where that is done. So we're going to be talking about a lot of areas of credit outside of the banking system. So the high yield bond market, the leveraged loan market, the bank loan market, the collateralized loan obligation market, CLO. I want to zoom in on the high yield bond market. I just did some back of the envelope math, and based on where the high yield spreads are, I said roughly going back to 1998, where they are about 3.3%. That 86% of the time going back to 1998. Credit spreads have been wider than that, indicating that the market is quite sanguine about the economic opportunities and that investors are not being paid that much above treasuries. So tell us, what is it like to invest in an environment like that?
Well, first of all, Jack, I mean, you're tight compared to history, but I think there's a few things that you have to think about maybe that go just beyond the spread itself. The first thing I would say is the yield on high yield is between 7.5% and 8% today and over the last few months, which if you did that same analysis, you would find that would actually appear quite favorable over that same time period, especially if you zoom into the post-VanEck Ad was really your only source of return. So if rates were 1% and you had that 3.5% credit spread, you'd have a 4.5% yield. So again, about 300 plus basis points behind where that yield is today. So I think the yield alone is a big factor. And I do think that's something that has driven investors to continue to invest in high yield and, quite frankly, find high yield attractive. The other factor that's important to note in high yield is that on average, you can still buy high yield at a discounted price. And that's important in fixed income because that does give you room in the event that a bond were to get refinanced before its maturity. Remember, the yield that we're talking about, that call it 7.6, 7.7%, assumes that bond stays out and I trade at a discounted price. There's room for me to have even greater yield than that 7.6. It might actually mean that on average, the market has a yield closer to 8. Again, making it quite attractive relative to history. And I think another factor that might get overlooked to some degree is the significant increase in quality in the high yield bond market that we've seen over the last several years. If you remember, during COVID in March 2020, we experienced a number of downgrades, and a lot of these downgrades were investment grade rated companies or fallen angels entering the high yield bond market. That significantly boosted the percentage of BB rated bonds or bonds that have the highest rating in the sub-investment grade space. And at the same time, you had a number of the worst rated companies or CCC rated companies default. So CCCs are down, BBs are up. On average, you have a higher quality market. So again, when you make those comparisons to history, quality adjusting, duration adjusting, those are factors that people have to consider. And again, that works for a lot of portfolios today that have even asset liabilities or just a desire to earn a mid to high single digit return.
And what are you seeing in terms of the defaults in a high yield market?
Yeah, so defaults have actually remained quite low over the last couple of years. If you go back to 2022, I think there was an expectation that you would see kind of two things. Number one, you would see credit spreads increase dramatically, and you'd see defaults pick up. And that is historically, something that was or would happen in the event of a recession, as many people expected that recession to come. Instead, defaults remain low, And I think one of the big reasons for that is that we did have a number of defaults during COVID. And some might think, oh, when COVID hit, you probably had a number of good companies that ended up defaulting because the economy shut down and everything was slow. That's actually not what happened. A lot of the companies, a majority of the companies that defaulted in 2020 were companies that were already on their way to default. They were already under pressure, and that event in a way kind of, pushed them over the edge, so to speak. So COVID, in fact, ended up being somewhat of a cleansing event. And then again, pile on, as I said before, the increase in quality at the higher end of the market, the double B part of the market. And that kind of, in general, higher quality market has, kept defaults relatively low and, kept us an environment that's been pretty good for high yield investors that have been willing to, stay in that market and just earn that yield.
And so we can connect the relatively low amount of defaults in the high yield bond market to that factors that you mentioned of a lot of the defaults already happening in 2020, a lot of deals being refinanced in 2020. So the maturity wall isn't until later on. Perhaps other financial sectors of the credit market, such as leveraged loans and private credit, refinancing the riskier deals, is another factor. Just how the U.S. economy has outperformed expectations. And, as we record here in late July of 2024, the near unanimous predictions of economists in 2022, which I found convinced by, and I, interviewed a lot of these economists, close to 2 years ago, that there would be a recession. Is that related as well to the relatively benign credit environment?
Yeah, definitely. I think that alongside the fact that, many of these high yield companies have been largely responsible with their balance sheets, meaning they haven't gone out and been very active in making acquisitions or, things that would build leverage in their portfolios, unnecessary spending of, doing capital expenditures to kind of grow their business. They've been content to kind of let their business grow organically, continue to bring in that cash flow, keep costs under control. You remember during the inflation period, companies were able to pass a lot of that on instead of, eating those costs and seeing their margins decline. All those events, I think, have, as you said, added up to a much better market. And really, again, where you have seen some of the defaults, and this applies to the loan market and other sub-investment grade, is it's been less about, kind of a broad, part of the market that's defaulted. And it's been much more idiosyncratic. So if you look at companies that have defaulted, it tends to be in industries that are under some sort of pressure, maybe from regulatory changes or just from, broader changes in the economy or consumer behavior, such as, areas like media, cable, things that are going through some sort of structural change that has left some companies behind.
When you look at the broader world of credit, so looking at collateralized loan obligations, looking at bank loans, private credit, non-agency mortgage-backed securities, everything you look at, is credit priced as optimistically as the high yield bond market is?
In general, I think over the last few months, you've definitely seen some, compression in credit spreads generally. What I think we've seen over the last couple of years is that not all markets reacted with the same speed, perhaps. You did mention CLOs, collateralized loan obligations. I think some of these parts of the securitized or structured credit markets were a little bit slower to react to this. And I think one of the unique things there is that you have, different factors involved in those spreads. You obviously have the spreads of the underlying collateral, which for a CLO is that broadly syndicated loan market. But you also have the spread that's involved in financing these vehicles. These are leverage vehicles that need financing. And once the Federal Reserve started quantitative tightening and banks were concerned that their reserve balancing brought reserves up, you would expect quantitative tightening to bring reserves down. That limited some of their capital activity in the early onset of that quantitative tightening. And I think that did contribute to some of the spreads in these structured assets to go relatively wide to where you would see spreads in similarly rated corporate debt. Today, those spreads have come down. I think in some cases, they're still relatively wide. There's still opportunity there, but you are seeing a little bit more convergence this year than we had definitely in 2023 and late 2022.
Forward Guidance is brought to you by VanEck. The VanEck Morningstar Wide Moat ETF, ticker MOAT, has outperformed the S&P 500 for over a decade. How? Moat strives to achieve a simple but challenging task. Buy quality stocks when they're undervalued and sell them when they're overvalued. Visit vaneck.com/moatfg to learn more. That's vaneck.com/moatfg. Now the disclosures. All investing is subject to risk, including the possible loss of money you invest. Visit vaneck.com to carefully read a prospectus before investing. The VanEck Morningstar Wide Moat ETF is distributed by VanEck Securities Corporation, a wholly owned subsidiary of VanEck Associates Corporation. Thanks, let's get back to the interview. And if I were to ask you, what is your credit outlook right now? As someone who has client money to put to work, how do you go about allocating in the credit markets when things are priced quite optimistically?
It's really a relative value decision that has to be made. And again, you're always making some sort of trade-off. When I think about, where we want to invest in credit markets, particularly, let's zero in on the sub-investment grade markets. Some of the trade-offs you're thinking about are, do I want duration in my portfolio? Having those high yield bonds at discounted prices, that's pretty attractive. I get some duration. Obviously, we've seen rates come in over the last couple of months. Longer duration has helped there. But as we've learned over the last 2 years, trying to, fully appreciate and guess the timing of when these actual rate shifts will occur has been difficult. So you can offset that with floating rate securities that have no duration. They're trading closer to their par prices, but their coupons are just much higher, and the amount of income you generate is much higher. If you look at the yield curve, and many people will know this, it's inverted. What that means is the highest rates are at the shortest end of the curve. If I buy a broadly syndicated loan, that loan's floating rate index is short rates, either 1 month or 3 month SOFR rates. They're 5.25% to 5.5%. So my coupon on a loan is going to be about 300 basis points above the average coupon on a high yield bond. So again, if I'm unsure of timing, I can balance off some of that, lower income, higher duration, high yield with a higher income generating shorter duration security like a loan. That's some. I also might look at structured credit because it just has higher absolute yields. Again, in the world of trade-offs, that might come at a cost of potentially some lower liquidity and the potential for some higher volatility. But again, when I'm mixing that up in a portfolio, that mix makes a lot of sense. And again, if things remain relatively calm and we continue in this environment where we seem to be, the ever talked about recession that hasn't occurred yet, it remains a little bit further away, then again, I really like the fact that you can just collect a lot of income in the meantime, which really does protect you against, future volatile events.
So duration is interest rate risk. So when you own something that is you're paid back in 5 years, if interest rates go down, that is generally good for the duration part of your thing because you bought it at a higher interest rate, whereas these shorter date things have no duration. So if the Federal Reserve cuts interest rates in September, as is widely is expected now, the markets are pricing that, then instead of SOFR being 5.3%, it will be 5% or 5.05%. So your income goes down. Yeah, I mean, how much do you think about credit risk, the risk of being paid back versus duration risk? Because for so long, as people have been pricing in a recession, they priced that the Federal Reserve would cut interest rates, and so far they haven't. It appears though that for this time they actually will, this year. But how is that affecting your how you're seeing things?
Yeah, again, I mean, I think it goes back to that discussion of trade-offs. I think one of the things that we do know is that, yes, you're right. The market is quite certain that the Fed will cut rates in September. The market was quite certain at one point they would cut rates in March, and they did not. So we never really know. But the real question is, as you said, what's going to happen to credit spreads during that period? Because again, you are exposed to both of those risks. I think that's why in a portfolio, you do like an investment like high yield, where should credit spreads go wider, it most likely corresponds to a period where interest rates would be declining. Credit spreads wider probably means some form of economic slowdown, whether that comes, through the consumer slowing down or some other factor. So you do get almost an offsetting effect. As you said, if you have a 3-duration high yield bond and interest rates fall, that's good for the bond. If credit spreads go wider, that's negative for the bond. So there is some offsetting. And again, I think where the floating rate securities come into play there, and why it's important, I think, today to have these in your portfolio, is because, again, I like taking that. I don't mind as much taking that spread risk in a floating rate security, because I know that I'm getting more income today than I am in that fixed rate security. So that protection I have in a high yield bond from duration and rates going down, in a way, I have some of that protection today, as long as those rates are not being cut and I'm earning a much bigger coupon. So I'm kind of building in protection over the coming months, and again, kind of having that to rely on if we do get a cut in rates, and the future of that cash flow is declines, as you say.
And how are you assessing the probability of Federal Reserve interest rate cuts, steeper than expected interest rates cuts, as well as the R word, a recession, which has been predicted for 2 years and so far is not with us?
Yeah, I mean, we're recording this on July 25th. The second quarter GDP just came out at 2.8%, much higher than anticipated. So it's, given the further strength in the consumer, it's really hard to see a recession coming imminently. Now, I think there's no doubt that there are many signs of slowdown, and there's probably a building consensus. But I think that's what makes it so difficult to, kind of forecast these things. As our chairman, Howard Marks, often says, it's very difficult to understand the timing of these events. And if you make your investments solely reliant on getting the timing of those events correct, it's going to be difficult to have a consistent track record. This is where I think, fixed income does make a lot of sense in portfolios today, because if I buy a portfolio with a stated yield, that is the yield, that is the return I will make if I don't give that up in the form of defaults and loss. So again, I have some element of protection just through the yield that I'm buying at. And I think that really does speak to, where and how people should think about fixed income, especially sub-investment grade fixed income today in a portfolio. What I mean by that is, historically, we might be encouraging investors, hey, you should, take your investment grade or lower yielding assets and, trade up into higher yielding, slightly lower rated assets. Today, I think the argument is actually different. It's actually, those who have a lot of investments in the equity markets that have obviously done very well might want to consider, moving some of that risk down into these higher yielding fixed income assets, where again, that income is locked in the form of a yield. Because all these events that you've mentioned that are going to be potentially negative for credit markets are certainly going to be challenging for the equity markets. So again, trade a little bit of risk down, pick up some locked in yield. And I think that's what's drawing people into that market today, despite some of those tighter credit spreads.
And tell us what you're seeing in the bank loan market as well as the CLO market. A little harder for amateurs such as myself, non-investment professionals, to get a sense of what's going on there, unlike the high yield market.
Yeah, I think one of the things that's important to note for people is that in the past, the bank loan market and the high yield market had a lot of things in common, a lot of issuers in common. you would see a company issue a loan, a secured loan, a first lien loan, and then issue a high yield bond as an unsecured bond in that same capital structure. And that really, meant that you could, do an analysis on an issuer, determine, do I want to own the most senior piece? Do I want to own the junior piece? Am I worried about default? Do I want the protection of that senior piece, which should give me a better recovery and a better position in the capital structure? Or do I want that unsecured piece at a slightly higher yield? Today, the bank loan market has really become largely a place for a lot of private equity M&A activity or leverage buyout activity to use in financing. And that has really limited the set of issuers that cross over between the loan market and the high yield market. So you really do need to look at those markets in some ways, independent of one another. We've seen some of the changes that has brought in that recovery rates in the loan market have declined from their historical levels because you no longer have that bond underneath. But it's also meant that you have, a lot of opportunity to earn, maybe slightly higher yields and higher spreads than you otherwise would have. And in this market, or certainly over the last 2 years, the loan market has provided a lot of opportunity to earn pretty attractive yields in this floating rate debt. Now, one of the things that's challenged that market is the fact that these companies have been paying more in interest over the last 2 years than their high yield counterparts. And this is due to the floating rate coupon. A high yield bond issuer that locked in a 4% coupon in 2021 that didn't have a maturity until maybe 2025 has enjoyed that 4% coupon that entire time. A loan borrower that issued at, say SOFR plus 400, they went from paying a near 4% coupon to now an over 9% coupon. So you've seen that double. And that has seen some more increased downgrade activity within the loan market relative to the high yield bond market. There's a growing amount of single B and single B minus credits in the loan market relative to the high yield market. And I think that speaks to the necessity of really having a good underwriting process in the loan market. I think the loan market is probably more challenging to take a more passive approach than the high yield bond market because you want to and need to make sure you're going to avoid some of these potential trouble spots in the loan market. And that's revealed itself in defaults. We talked about defaults in the high yield bond market being relatively low. They're still relatively low in the loan market, but they are above the default rate in the high yield bond market over the last couple of years.
And they are rising. Default rates are rising in the loan market.
They have been slowly rising, not as maybe as fast as some people would have anticipated this year. This is actually one of the, I think, unique things in the loan market versus the high yield market is just as more high yield borrowers are starting to refinance into this higher rate environment, loan borrowers, because they have no call protection or there's nothing locking in their position for a number of years like a high yield bond, they're free to refinance whenever they want. So what you're seeing this year in 2024 is that loans that were issued in late 2022 or early 2023 are actually now refinancing at, on average, spreads that are 50 to 60 basis points lower. So loan borrowers are, in a way, getting a little bit of relief from those higher rates through their refinancing efforts, despite the Fed not cutting rates yet. So I think that has helped them with some of their interest burdens.
Okay, that's really interesting. So a high yield bond investor, they are locking in their financing rate. And when rates were super low, interest rates were zero, and they could, with the credit spread, they could get 4%, pay only 4%. They're still paying 4% now. Whereas for borrowers in the loan market, their interest expense has gone up as interest rates have risen, and they've gone up 530 basis points, or let's say 500 basis points. That is a lot. And you're saying they're refinancing because the credit spread has narrowed. So The benign credit environment, the sanguineness of credit investors, of folks such as yourself, is allowing them to refinance. So it's actually, they're taking income away from, folks like yourself. So you're probably, none too pleased, but they are getting that, 30 or you said 50 basis points of relief. But how are they handling that 500 basis points increase? They said, I wish I locked in my rate in the high yield bond market, and I wish I locked in my financing before the Fed raised interest rates. If they were paying say 400 basis points of SOFR, they were paying 400 basis points when interest rates were at 0, and now that rates are at 5.3%, they're paying 9.3%. So their interest costs have more than doubled. Is it surprising to you that the companies have so far been able to handle this, without a much higher increase in defaults?
Yeah, I mean, definitely, you're right in everything you just said. I mean, as investors and lenders, I mean, we are seeing yields, decline from those peak rates that we saw in 2022 and early 2023. But again, you're kind of trading off almost maybe a decrease in default risk for a slightly lower coupon, but it's still at a level that's relatively attractive. So that's still pretty good, and we're happy to lock that in. But yes, I mean, I think one of the things that has impacted is just companies' overall ability and free cash flow to, expand business and reinvest. It doesn't necessarily mean that we are at risk of not being paid back. I mean, these companies on an interest coverage ratio, which basically, expresses the earnings as a ratio of their interest costs. For many of these loan borrowers, it still is above 1. For many, it's above 2 and even above 3. So although it has hurt and chewed into their overall, earnings they have, for many, they're still in a position to be okay. And I think another thing that has helped the loan market, I think you alluded to this earlier, Jack, was the fact that private credit has been a solution to some of the more challenging issuers in the loan market. We certainly saw this in 2023, where some of the lower rated borrowers, which are not good fits for the CLO market, were refinanced by the private credit market. And I think that's an important point to make. When you issue a CLO, that collateralized loan obligation, you must adhere to certain criteria. You have rating criteria. You have these metrics that you need to keep in mind when building a CLO. One of them that is quite common is a threshold on CCC rated loans, and that tends to run around 7.5%. So if I'm constructing a CLO, I'm probably not going to construct that CLO right out of the gate with a lot of loans that are B- rated or right on the cusp of one notch downgrades into that CCC, because that can impact my CLO greatly, as I have to switch and mark that collateral to market, given that as soon as that downgrade occurs, when I'm above that 7.5% threshold. So again, in a market where about 70% of the loan market is owned by CLOs, if it doesn't fit a CLO, you're going to have more trouble finding that refinancing partner. And again, that's where private credit has become a great solution provider to some of those borrowers, again, to move them away from the broadly syndicated loan market and into a market that is more easily able to refinance them.
Hello, everyone. Permissionless 3 is coming to Salt Lake City on October 9th. The event for crypto natives is heading west, and we are bringing the biggest names in crypto together for an insane, can't-miss event. Hear from more than 200 industry titans, including Balaji, Mike Novogratz, and Dan Tapiero. The conversations at Permissionless will be covering the hottest themes in crypto, including modularity, restaking, the Bitcoin and Solana ecosystems, AI and crypto, rollups and L2s, institutional adoption, and of course, the November election that will be right around the corner. We couldn't be more excited about this event. Get your ticket today, and make sure I get some bragging rights by using my code FG10 to get 10% off. That's FG10 stands for Forward Guidance. I want to see you there. Do it. It's going to be at one of the most beautiful places in the United States, and everyone's going to be there. Van Spencer's going to be there. Jim Bianco's going to be there. Jan VanEck's going to be there. So what are you waiting for? Get your tickets now by clicking the link in the description and use code FG10. Back to the episode. And you said some companies that have a interest coverage ratio lower than 1. Does that mean that their interest expense is greater than their EBITDA or their earnings?
If an interest coverage was below 1, yes, their interest expense would be greater than their EBITDA, correct.
And so that doesn't sound like a terribly wonderful scenario to be in if you're lending money to a company. So you're saying these deals are riskier, but they're being moved out of the leveraged loan market and being financed by private credit funds, which have seen an explosion of inflows. So there's just a lot of money going into private credit. But depending on how you measure it, according to the Federal Reserve, in 2001, there were only $40 billion in private credit strategies. And now there's $1.7 trillion. Only some percentage of that 1.7 trillion is in this, riskier direct lending type stuff. But it certainly is a lot of money. I guess what I want to ask is the interest coverage ratio below 1, companies not making enough to pay their debt. How common is it that companies encounter that problem? I imagine in a tougher macroeconomic, tougher credit environment, it's a higher percentage. I imagine it was high 2008, 2009. In a benign environment, it's lower relative to where you've your entire career in credit. How does it compare what you're seeing now in terms of the percentage of companies in the leveraged loan market where they're not making enough money to pay their interest expense?
Well, first of all, I do want to clarify that I did not mean to imply that private credit is refinancing all these companies with interest cover ratios less than 1. I mean, private credit obviously wants to refinance good companies that are in a good place to pay back their debt. I think the more common thing is for private credit to refinance the lower rated companies. Again, they may have interest coverage ratios of 2 or 3 times and certainly in a position to pay. But to your point, I mean, it's a pretty small part of the market overall. It has grown. And what you are seeing, and this happens potentially in the loan market, and you're seeing it in the private credit market, is companies are trying to get more creative with how they pay that coupon. And you're seeing some combination of payments in kind, and that might be a full payment in kind, or you're seeing partial payment in kind. And I think this is one area where the private credit market is probably better set up to handle these kind of situations than the broadly syndicated loan market, because you're not dealing with as many participants in that lending pool. You might have to, have that discussion with a handful of borrowers that really don't want to see a company default. They believe in the long-term possibility. And so you're willing to, create these solutions that are good for the borrower as well as good for the lender. And again, more often than not, we've seen that grow through, again, these partial or full payment in kinds.
So a payment in kind, it is when the lender gets paid in more debt. So they don't get paid in cash. And as people can guess, it's not Apple or Microsoft. They don't do the payment in kind. It is the more stressed companies, and this payment in kind is going back to the 1980s and probably before then. And the argument is private credit is the best place to have this credit risk. If it is on the balance sheets of banks and there's a huge default, then that could impact the broader economy and bank shareholders and bank capital, because banks are levered. The private credit world is a lot less levered, and it is sophisticated institutional investors, it's high net worth individuals, it's sovereign wealth funds, it's university endowments, and they are the ones who can handle this credit risk. Is that the argument?
I think that's true. I mean, again, nobody wants to deliberately sign up for credit risk unless you are intentionally a distressed investor. But when you're looking at performing credit, I mean, that is not the outcome that you look for. But I think you're right. When those situations do arise, you can probably delay the immediate default that might happen in other situations and give a company a little bit more time to get through a challenging period and work that out. Now, That's not going to work for everyone. Some businesses will be broken and will have long-term problems, but yes, I think those situations are better served, or certainly shown to be more easily handled in those private credit situations. And I think, not surprisingly, that's why you've seen a number of lenders who have been active in the private credit space increase their teams when it comes to some of those abilities to get through these distress situations.
Right. And so you said something, people don't want to sign up to take credit risk. And of course, that's true if you're being paid zero or close to zero for that credit risk. But if you're being paid a 20% credit spread to take a credit spread where there's a 4% chance that it goes bad and there's a default, that's probably a good risk to take. And actually, Howard Marks had a memo about how often, I believe it was this year, not taking risk is the greatest risk of all. And I'm sure credit investors over time have vastly outperformed investors in 3-month treasury bills. So it's about the relative risk, and private credit spreads have been quite high and they've come down. So is that why, when I turn on Bloomberg, I'm seeing articles and TV chyrons and headlines about the golden age of private credit? Is the performance because credit spreads were quite wide in 2022 and 2023, but they've come down somewhat, and that is a good way to get paid in credit?
Yes, I mean, definitely. I think there's a couple of things that have been very attractive about private credit. The premium you can receive over similarly rated or other public credit sources definitely is one. And number two is the lack of volatility in those prices. You don't see the same market moves in reaction to a shift in interest rate expectations, or a potential widening in high yield credit spreads, or equities selling off. And that kind of lack of volatility combined with that higher return is certainly something that I think has made private credit a very, very attractive place to go.
So something being illiquid, some clients can view that as a good thing. I never went to business school, but I imagine that at business school they teach that liquidity is a good thing, and something that's illiquid, investors should be paid to hold that. There should be a illiquidity discount or a liquidity premium. Are you seeing kind of the opposite, where there's an illiquidity premium, where people say, I don't want to look at my high yield bonds or my stocks that are flip-flopping every single day based on economic data and some news. I just want to, get my account statement at the end of the quarter and everything's fine.
Definitely that does help. And there are certain investors that have, benchmarks and others that are related to, how much volatility you have in your portfolio, and those, kind of, non, active mark-to-market strategies certainly kind of fill that void. Again, it doesn't necessarily mean you've avoided all the problems. And I think some of those are starting to surface today. And you're hearing more about some of these, private lending deals that have happened, certainly kind of in the 2021 period, where interest rates were near zero. Deals were underwritten with the expectation that interest rates would stay low. And now, again, as you've said, that has taken a bigger chunk of people's earnings. Maybe earnings haven't grown as fast as, some would have expected in 2021. So you really are kind of getting hit with maybe less earnings growth, higher interest costs. And I think you are seeing a little bit more of that trouble start to come to the surface, which again are going to be looking for new solutions to help refinance, fix balance sheets, and get through this troubled period.
And what are you seeing in the portfolio companies that, I should mention, Oaktree is a world leader in credit, around $150 billion in management, just specifically in credit. All assets are very close to $200 billion. And according to the Federal Reserve, of all private debt strategies, you have over $100 billion. But again, it's how you characterize private debt. And in terms of direct lending, according to the Federal Reserve, who, obviously Oaktree knows more than the Federal Reserve about Oaktree, but somewhere in the teens of billions of direct lending. So is everything we've talked about, is that called direct lending, or is that something different?
Yeah, I mean, I think you're right. There's certainly a number of different ways you can think about that definition of direct lending. I think the most common today is in what you see in the private credit market, which would largely be sponsor back deals. So you have a private equity firm that makes an acquisition, does a leverage buyout, uses private credit as a form of financing that buyout. And that's probably the most common today. Some of that does happen in the broadly syndicated loan market as well, but that's probably the most common form. But yes, more recently, you have seen some forms of I'll almost call it rescue financing, where companies are in need of new capital solutions that are again kind of fixing some of these troubled balance sheets. I think that's another form of private credit. You have non-sponsor lending, where you don't have a private equity sponsor involved, but you have a company that is non-public, is not going to the public market to issue a broad deal in the high yield bond market or the loan market. They need a partner. Their business might be a little bit more complex than others, so somebody needs to pick up their pen and do some underwriting and homework, and those are areas where you can also really pick up a pretty healthy premium to what you would otherwise earn in the public markets. And so I think being able to flex around those different solutions in private credit and have the capability to be willing to do some form of rescue lending when it's attractive, do a form of sponsor-backed lending when it's attractive, focus in on non-sponsor lending when it's attractive. That's really the best way to kind of build these portfolios that are really designed to get through multiple market cycles.
If we encounter a recession, what the high yield bond market will do in terms of credit spreads, in terms of defaults, it obviously will depend on a whole host of factors, but the high yield bond market has been through many recessions. Do you know what typically happens in previous economic downturns to private credit companies? Is that a tough question to answer, because in 2007 the private credit market, which was much smaller, in the 2003 recession, 2001 recession, it barely existed, and then the COVID recession lasted for 2 months.
Yeah, I think you're right, and also, I mean, there's certainly been an evolution of how that market's worked. I mean, you had a lot of private credit historically was in mezzanine financing. Now you've seen that move up into more kind of first lien financing. You used to see first lien, second lien, maybe some form of mezzanine. Now you're getting that lumped more together in deals they call unitranche deals. So deals that in total have much more leverage than a traditional first lien deal would have had. So I think there's going to be a lot of discovery or maybe kind of reckoning ahead for those who didn't fully appreciate the difference between taking a 4 times levered, and when I say leverage, I'm talking about debt to EBITDA or debt to earnings, company, as opposed to a 7 times levered unitranche deal. So I think it's hard to answer that. And again, just the fact that it is private credit, unlike the high yield bond market, which is public, those defaults are known. Moody's, S&P, Fitch, they all have histories of those default rates. You can see what they are. It's difficult to fully appreciate, what those are in the private credit market. And, could it be higher than it was historically? Maybe. But again, I think there'll always be some level of opaqueness to what those numbers actually are, even going forward today.
And someone like me, or I imagine most of the audience, very opaque to get someone. You have, I'm sure, great clarity into the deals which Oaktree is involved in and gets to see. But are even you able to get broad industry-wide data? I mean, I know places like the IMF and the Federal Reserve have attempted with very smart people to get a kind of grab your hands around how big is this market, what are the risks. But like there are, for example, SIFMA, they do, okay, this is how many high yield bonds were issued this quarter, and it's just the number is what the number is. Can you just share how opaque is the market to non-professionals such as myself? how opaque is it to professionals such as you?
Well, I mean, look, we certainly get a look at a number of deals, and so we're probably seeing a lot of that flow come through, and we're making decisions all the time of whether or not we want to invest. We're passing on deals a lot. And when those deals come, there's always a way to see who was involved in that deal, what's happening with that deal that I may have passed on. You want to stay in that flow because there's perhaps an opportunity to come in and support that deal or even offer some form of rescue financing or new financing to a deal if they get in trouble. So yes, you certainly want to and will, an Oaktree will, track that market and will certainly have better insight than, again, like an investor who's only involved in the public markets. Exactly what happens and what you do, I think that, largely depends on, the path of the economy, the path of certain industries, and, that outcome, I think, is, kind of yet to be determined.
And so you are involved on the private credit team. It's my understanding it's not the sole thing you focus on. Is it correct to say that you are involved more on the deals that are non-opportunistic? In other words, they are slightly less risky than other deals. Is that correct?
So for me individually, I focus primarily on public markets here at Oaktree. We have multi-strategy portfolios that do consist of both a combination of public and private investments. And I think those are a great opportunity to, see what you can earn in the private markets. You can use that relative value analysis to, determine, does it make sense for me to add this to my portfolio today? Again, as I said before, for us in this multi-strategy framework, a lot of times you're making those trade-offs with public and private securities. That trade-off largely comes in the form of liquidity that I'm going to give up, and am I getting compensated for that liquidity? So for me and my world, I don't spend as much of my time dedicated into the private markets, but certainly see that as again, we have some crossover in public portfolios.
So to tell us about when a private credit deal is sponsored or non-sponsored. Does that mean you're lending to a company that is owned by a private equity company, or you're lending to the private equity company itself? And then tell us, does Oaktree, do you care that much if the money is used to go into the company, or is it a concern for you, or are you going to discount the risk that the private equity company could take money out of the company and use that to pay investors? Because in 2020 and 2021, a huge amount of deal activity in private equity companies went up a lot in value. Now there are a lot fewer exits in private equity, and based on what I've read, private investors in private equity LPs are asking, "Hey, can we get some distributions?" So I've read that private equity companies, to some degree, are using private credit loans to pay their investors. Is that roughly accurate on a macro level? Number one, and number two, is that a concern for you?
So I think to your first question, I mean, a sponsor deal would be, again, lending to a company that is sponsored by a private equity through some form of leverage buyout. So you're not necessarily lending to the private equity sponsor, you're lending to the company that they're taking private. A non-sponsor deal would be really a deal negotiated directly with the company. There may be no private equity, company involved at all. That might be a life sciences company that needs financing as it's, working through its current path to get certain drugs out to the market. So again, there is that differentiation there. I honestly, for myself, don't have great insight into exactly what % of deals are being used for a dividend payout or something like that. I mean, to some degree, whether that company used existing cash on the balance sheet or used that financing, it's hard to distinguish that difference. Cash is cash, but it's certainly something that you'll want to be aware of is where that capital is going, what's happening to the free cash flow, and ultimately the leverage profile of that company. So something that is certainly needs to be monitored.
So are we in the golden age, Wayne? The golden age of private credit?
we're definitely at a period where I think private credit has, been a valuable tool to, get financing to companies that otherwise, would have had difficulty financing. I think private credit has provided, good excess return and been able to offer that more broadly to more underlying investors. I think one of the challenges in private credit is that you don't always line up supply and demand. So, there can be times when there's a, bigger demand for private credit than there is a supply, and you'll see spreads tighten on existing deals as people need to put money to work. I think one thing that we know is that ultimately over the next few years, I think private credit will continue to grow. It will be needed to, satisfy, the capital that private equity has raised. Again, it's that timing and that supply demand dynamic that I think is going to ebb and flow, over time.
In a financial crisis, companies need financing. There's a lot of demand for financing, and the supply shrinks back. No one wants to lend. It sounds like you implied that right now it kind of is the opposite, or over the past 2 years, it's been the opposite, where there's been a lot of private credit money raised, and that surplus of cash might even exceed the amount of private credit deals that could be done. So it's kind of the opposite of a credit crisis, or it's an issue of the other way, where there's too much money chasing too few deals.
I mean, look, when spreads go tighter in general, and that's not unique to the high or to the private credit market. That would exist in high yield, that would exist in loans. When there's too much credit or too much money chasing too few deals, you will see spreads go tighter. Those are certainly periods where you want to monitor. I mean, our chairman Howard Marks has written a lot about, what happens when you get those situations where, when money is easy, that tends to be where companies that, probably have, less credit worthiness, can access that capital. I would say, the answer to that question is that's where you really do need to focus on active management. And you really do need to have a manager that's doing that security by security selection. I think it's very difficult right now to want to, run out and buy a passive index, even on the public side, whether that's bonds or loans, in the high yield or loan market, because again, you just don't know exactly where some of those troubles are going to come from, and being able to, have that active management piece should allow you to, again, avoid some of these challenges, which we know and often do reveal themselves down the road, 1, 2, 3 years, down the road. And you need to prepare for that, today, especially in private credit, where your opportunity to exit that deal is going to be, 0 to very limited.
That's very interesting. So going back to what we discussed at the beginning, high yield credit spreads are at the 86th percentile in terms of tightness. So the overall index, that is what's available to a passive investor. In the equity market, some great investors do, over a long time period, outperform the index, but it is very, very, very difficult. However, what's interesting is that in the credit markets and the bond markets, there's a greater percentage of managers who outperform the index. Why is that the case? And how might you attempt to beat the index right now when credit spreads are 3.3% over treasuries?
Yeah, I mean, you do make a great point. I think, active management does, really suit the credit markets, where again, you can make those distinguishing bets between those companies. I think one of the biggest things that, kind of drives that outperformance of active management in credit is simply the fact that everything isn't liquid. You can't just buy every single name in the high yield bond index. And so if you're a passive fund that's tracking that index, you're going to have to buy what's most liquid and what's available to you. For us, when we can look a little bit closer at that, I think right now it's very interesting in the high yield bond market. As you said, spreads are, in the low 300s today in spread. But if you look at the actual composition of one of the, high yield bond indices, you'll see that about 75% of those indices is trading with a spread actually below 300 basis points. So you're in this situation where if you're going to be trading in the most liquid part of the market, it's probably going to be very difficult for you to have a portfolio that even looks like the high yield index. Another thing we look at from a dispersion standpoint, and dispersion, meaning, how much of the index looks alike versus how much doesn't. If you look at the percentage of the high yield bond market that is trading within plus or minus 100 basis points of the index yield. So if the index yield today is, call it 7.6% here in late July, then something that's 6.6 to 8.6. Only 28% or under 30% of the market is trading within that plus or minus 100 basis points. So, being an active manager and being able to determine how can I construct a portfolio that looks more like the index, and determining what to avoid, what should my balance in tighter spread, higher quality names be versus some higher spread, maybe lower quality names, is much easier for an active manager than a passive manager. And I think that's why you've seen, some of this outperformance this year in active management, because number one, duration hasn't really cooperated for the full year. It has maybe over the last few months. So if I had a longer duration portfolio in the higher quality part of the market, I've underperformed. If I could balance that with good credit selection and a limited universe, then I've been able to either keep up or potentially outperform. So that inability to transact in all names and kind of being forced to go where liquidity is, and I have to do the least amount of potential credit work and really seek to avoid those credit problems, it's just much easier for an active manager to navigate that market than a passive fund.
And a lot of passive funds get redemption, especially in the ETF. So that's why they need to own a lot of liquid stuff. If $1 billion comes out, they got to sell that stuff too. So that's why they need to own that. And active managers who don't have that issue can buy the more illiquid product. So Wayne, earlier you said a quote about Howard Marks talking about when money is easy. So money in terms of the risk-free rate, it was definitely easy when interest rates were at 0, and it is definitely not easy at 5.3. We can debate about R star, but just looking at credit at the spread, forget where the risk-free rate is credit easy right now?
There's definitely a lot of capital that is available to be invested. You're right, rates are higher, and so the cost of money has increased, but you've had a lot of capital that has been enjoying earning, a 5.5% yield by rolling 3-month treasury bills. And people know that eventually that capital is, if the Fed cuts rates, I'm not going to be able to earn that same amount. And so there is some, of that money maybe coming out into the credit market, seeking to lock in some of those higher yields for longer, knowing those rates are coming down. And you've seen that in refinancing numbers. If you look at the broadly syndicated loan market, if you look at the high yield market, both of those markets have seen a significant uptick in issuance this year over what we saw in 2023. Now, that's been a good thing because I think that's helped push back some of those pending maturities that were going to happen in 2025, definitely previously in 2024. So, there's positives that you've, helped the market maintain its need for capital. But as you said, spreads are tighter. So you've had some instances of excess capital coming in and pushing those spreads tighter.
And so loan issuance this year has been record volumes. Is a lot of that refinancing where the loan, was due with a certain time and it's just been refinanced at a slightly lower credit spread?
Yes, that's correct. A lot of the activity in the loan market has been refinancing loans. As I mentioned before, some of those loans that were issued in 2022 or even 2023 have been able to come back into the market, get lower spreads. That's why it's you kind of have that counterbalance between a high yield issuer refinancing into higher coupons and loan borrowers refinancing into lower coupons.
So there's been, in the loan market, there's been more leverage, more downgrades. But you said on a previous call that when CLOs go into the market, it looks at 75 to 80% of the market. And you had an interesting view about who is financing that bottom 20% of the market. Is it legacy CLOs?
Legacy CLOs will definitely own some of that. Institutional buyers that have loan-only funds will certainly own that. There's a number of different places and people who have that on their balance sheets. Again, from a refinancing standpoint, as we talked about, private credit has taken some share of that more last year than they have before. So it's spread out. But again, CLOs, you're right, are certainly the financing or the buyer of the majority of the higher quality or top 75% of the loan market. And why I think that's important to note is that when people hear about CLOs, even today, they often think back to the 2008 financial crisis and think about, weren't those, collateralized loans or these securitized assets, weren't they the source of the, financial crisis itself? And, really CLOs just don't have the same default rate that some of those mortgage-backed securities did, even at the lower rated tranches in the BB and certainly BBB tranches. And a lot of it is because if I buy a new issue CLO today, that new issue CLO, as you said, is really buying that top, 75% of the market. So I have a pretty good quality collateral pool, which on average is at a higher quality than the overall market. And in order for me to be impaired in even some of those junior tranches, I need significant defaults to occur. But again, I need them to occur in a higher quality collateral pool than the broader loan market, as a whole. So, that's been one of the drivers of making CLOs, I think, a very attractive investment for, public fixed income investors like us.
Everything we've talked about, private credit, high yield, loans, collateralized loan obligations, as well as non-agency mortgage-backed securities, where are you finding the greatest risk reward? In other words, what asset class do you right now love?
Look, I think there's certainly cases to be made for each of them. As I said before, today even more so than in the last year, having some balance between longer duration assets and shorter duration, higher interest paying assets is a good mix today. I think overall you are seeing some still relatively attractive pricing in the structured credit market. You mentioned non-agency RMBS. I think that is a pretty attractive place right now. And again, many people will think about, wasn't the mortgage market the source of problems in a financial crisis? I don't want to own that if we're going into a recession. But that market, that RMBS market, is very different than it was pre-2008. In that period, you had loan to values that were near 100, sometimes even greater than 100. You had borrowers that were, low quality, FICO scores in the 500s, lots of subprime borrowing. You see a very different market today where loan to values are, closer to 70%. Borrowers' FICO scores are above 700, in the mid 700s. So you really have a good quality market. House prices, despite mortgage rates going from 3% to 7%, are up 50% since 2019. So you have a lot of cushion in that market. There's a pretty big supply deficit in the housing market, residential housing market overall. And what I like as well is this is an asset class that has a positive boost if we see interest rates decline and we see some pickup or acceleration in prepayment rates. So I think a lot of things work well for that RMBS market. And again, you want to just diversify yourself away from a single risk factor that you can. So as I said, some duration, some floating rate, some secured or structured credit at higher yields, I think is a good mix today.
Got it. And then if I were to ask you an asset class where you think the risk reward is the worst, not that you don't own it, and again, you can try and outperform it. The area where in your portfolio, which you co-manage, where you can kind of invest in everything, it's what are you underweight the most?
It's not really so much about a specific asset class. I think it's about, certain parts of certain markets. I mean, if you look at the high yield bond market and the loan market, or let's say the credit markets in general, there are certainly going to be some sectors that have a greater potential for volatility and risk going forward. Specialty retail, is an area, or anything that's, more tied to discretionary spending. These are areas that you could see a greater chance of volatility. So it's less about, thinking about, I want to completely avoid this market. It's, where in that market do I find the best opportunity? And, I think that's something that is really key, because if you write off an entire market, you might miss those kind of unique opportunities. Emerging markets is an area that is, certainly has a mix of good quality assets that have great yields. And there are some areas of emerging markets where the macro backdrop may not be as conducive. And so you have to be careful. Again, speaking to the power of active management over passive management. The convertible bond market, same thing. You could certainly write that off as something, well, it's you need equities to perform for convertibles to do well, and the equity markets at their highs, and look what's happened over the last couple of days. But there are definitely cheap opportunities there. Not all equities have been hitting their all-time highs like you see in some of these tech names. And so I think being open to look for opportunities in each market and avoid the trouble spots has been one of the keys to success.
So it's not so much high yield bond market versus loan market, it's subsectors. And, I don't want to be too pessimistic. However, this is a credit conversation, and credit investors are pessimists because it's the downside you're trying to avoid. The best scenario is you get paid back, which is great. But there's no Nvidia is going to quadruple on you. So we got to talk about the risks. You mentioned specialty retail and emerging markets as areas where you're seeing the risk there really could be perhaps significant. Are there any other subsectors you are not feeling so comfortable with? What about, for example, commercial real estate?
Yeah, I mean, look, commercial real estate is something that can be very easily painted with the brush that says it's all bad, and really there you're kind of looking at one sector, which is the office space, which has not done well and definitely is under stress. But if you're willing to roll up your sleeves and do your homework across a lot of that space, there are a lot of good opportunities that are paying you relatively attractive yields still in that space. I think one area which I would highlight, which again touches more than the commercial real estate market, but you did mention the Nvidias and the getting into companies that benefit from that AI revolution. Well, there are places in the credit markets that also I think are able to participate in that same dynamic. Commercial real estate being one of them, in the form of data centers. So you need financing for data centers. They're definitely growing. Commercial CMBS deals are available for those, and can earn attractive yields. You also have asset-backed securities, which may benefit from the fiber that's being put into those data centers. You need power for those data centers, so you need companies that are focused on power generation. You're certainly seeing kind of a shortfall in some of the power needs to meet these data centers. So finding companies that are going to be on the cutting edge of that might come in the form of loans or bonds that can finance those. So again, I think kind of there's a lot of ways to gain access to some of these positive dynamics in the market away from just buying the underlying equities.
Wayne, thank you so much for coming on Forward Guidance, being so generous with your time and insights. People can find more about Oaktree, obviously, at oaktreecapital.com. Thanks again, and thanks everyone for watching.
Thank you, Jack.
Thanks for watching. Remember to check out vaneck.com/MOATFG to learn more about the VanEck Morningstar Wide Moat ETF, ticker MOAT. Lastly, Forward Guidance is available not just on YouTube, but on all podcast apps, and a video version is available on Spotify and Twitter, where I post interviews regularly. Thanks again. Until next time.